You're sitting at your desk, sipping coffee, when you realize something. The person who has a fancy car or expensive gadgets might not be as financially secure as they appear. The true wealth builders are quietly accumulating assets and saving money every day. Today, we'll uncover the habits that contribute to long-term financial security. Let's start with one of the most fundamental habits, saving consistently. Here's a common belief. If you save just 10% of your income each year, it can grow into substantial sums over time. But let's break this down. Imagine you're 25 and earn $40,000 a year. If you save 10%, that's $4,000 a year. Now, if you invest this money at an average annual return of around 7%, which is historically reasonable, in just 35 years, you'll have over $500,000. However, most people struggle to maintain even the 10% savings rate consistently. Now here is another habit, compound interest. People often underestimate how powerful it can be. Let's say you start with $20,000 and invest it at a 7% annual return. After 1 year, your investment will grow to about $21,400. That doesn't seem like much, does it? But if you leave this money alone for another year, it grows to around $22,938. And so on. By the time you're 60, assuming a consistent 7% return and no additional investments, that initial $20,000 could grow to over $145,000. The key is to start early and keep going. Another habit, avoiding high-interest debts. Credit cards are a prime example. Let's say you have a balance of $5,000 at 18% interest. If you make minimum payments each month, typically around 2–3% of the outstanding balance, it will take approximately 16 years to pay off that debt, and you'll end up paying nearly double the original amount in interest. That's right, your credit card is quietly robbing you. Next, understanding inflation. Inflation might seem small on a monthly basis, but it adds up. If you're living off of $50,000 a year now, how much will that be worth in 30 years if inflation averages just 2% per year? You'd need about $142,869 to have the same purchasing power as $50,000 today. That's why saving for retirement is crucial. Investing regularly and diversifying your portfolio is another key habit. Let's say you invest $300 a month in an index fund that tracks the S&P 500. Over 20 years, with average annual returns of about 7% before fees, compounded monthly, you'd accumulate around $184,698. But if you try to time the market or day trade, your chances of consistently outperforming this outcome are slim, and you'll likely end up losing money due to higher transaction costs and increased risk. Now let's talk about emergency funds. Many people don't have one, which means they turn to credit cards for unexpected expenses. Instead, having an emergency fund of at least 3 months' worth of living expenses can provide a financial buffer. Let's say your monthly expenses are $3,000. That's $9,000 in the bank as a starting point, no debt and less stress. Here's another habit. Staying informed about taxes and maximizing retirement contributions. If you contribute to a 401(k) or an IRA, every dollar you put in now can grow tax-free for decades. For example, contributing just $5,000 a year to a Roth IRA over 30 years, at an average annual return of 7%, could result in a nest egg of around $608,000. Now let's look at the power of cutting expenses. Imagine you spend $1,000 a month on dining out and entertainment. By cutting that expense by half, you can save an extra $6,000 a year. Over 35 years, if you invest this savings in a diversified portfolio with an average annual return of around 7%, it could add up to over $429,000 more in your retirement account due to the power of compound interest. One last habit, automating savings and investments. Setting things on autopilot makes it less likely that you will spend impulsively or forget to save. You can arrange for automatic transfers from your checking account to a dedicated savings or investment account at regular intervals, such as monthly. Now let's restate the central question. What are the everyday habits that quietly build wealth over time? Consistent saving, compound interest, avoiding high-interest debt, understanding inflation, diversifying investments, having an emergency fund, staying informed about taxes and maximizing retirement contributions, cutting expenses, and automating savings. Each of these habits can significantly grow your financial assets if you stick with them. But here's the part that the financial industry doesn't emphasize. It's not just about making smart choices. It's also about resisting temptation and sticking to your plan even when times get tough. The consistent habit of saving and investing, no matter how mundane, quietly builds wealth over time more reliably than any exciting alternative. So let's recap. We've talked about how consistently saving a portion of your income, ideally aiming for around 10%, can turn into substantial sums over decades thanks to compound interest. Starting early and letting your money grow is key, because even small amounts can accumulate significantly over time due to the power of compounding. Avoiding high-interest debt like credit cards saves you a fortune in interest payments over the long run, as carrying balances incurs costly finance charges that eat away at your savings potential. Understanding inflation underscores the importance of saving for retirement early, as it ensures your future purchasing power isn't eroded by rising prices. Diversifying investments through index funds, maintaining an emergency fund, maximizing contributions to retirement accounts, reducing expenses, and automating savings are all habits that quietly build wealth. These strategies may not be flashy or exciting, but they consistently and reliably contribute to long-term financial growth. And here's a secret. The real winners aren't just saving money, they're also minimizing unnecessary spending and sticking to their financial plans consistently. So remember, building wealth is about making small, consistent choices every day that can compound into significant results over time. This is educational and historical, not financial advice. One crucial habit is maintaining a budget and tracking expenses meticulously. By knowing where your money goes each month, you can identify areas for cutting back on non-essential spending. For instance, a $5 daily coffee might seem small, but over a year it adds up to approximately $1,825, $5 x 365 days. Redirecting that amount into savings or investments could make a significant difference. Another key habit is paying off high-interest debt as quickly as possible. Carrying credit card balances can be devastating. With interest rates often averaging around 15–20%, each month you're essentially throwing away money instead of growing your wealth. Prioritize paying down this debt, and consider using strategies like the debt snowball method to stay motivated. Building an emergency fund is also essential. This stash should cover 3 to 6 months' worth of living expenses to protect against job loss, unexpected medical bills, or other financial emergencies. Having this safety net helps you avoid high-interest debt and reduces financial stress during difficult times. Maximizing retirement contributions is another powerful wealth-building habit. If your employer offers a 401k match, take full advantage. This free money can significantly boost your long-term retirement savings. Additionally, contributing to IRAs and other tax-advantaged accounts helps defer taxes on investment growth and potentially reduces taxable income in the future. Cutting expenses can be surprisingly impactful when done consistently. Simple changes like switching to cheaper cell phone plans, negotiating bills with service providers, or even using coupons at grocery stores can add up over time. The savings from these habits provide more money to invest, which can then grow through smart investment choices. Automating savings simplifies wealth building by making it effortless. Set up automatic transfers from your checking account to your investment and emergency funds each payday. This ensures you consistently save without having to think about it, allowing good financial habits to compound over time. Regularly reviewing and rebalancing your portfolio is another crucial habit. Over time, some investments may outperform or underperform others, causing an imbalance in your asset allocation. Rebalancing involves adjusting your holdings to return to your original intended mix of assets, which helps ensure that your long-term financial goals are met while managing risk effectively. Staying informed about financial news and trends can help avoid costly mistakes and capitalize on opportunities. Understanding tax laws, investment options, and economic conditions enables you to make more informed decisions with your money. In summary, building wealth is a journey that requires patience, discipline, and smart choices. By adopting these habits consistently over time, you set the stage for financial security and growth. Remember, it's not about making big bets or seeking quick riches, but rather about the steady accumulation of small victories through disciplined financial practices such as regular saving, investing in diversified portfolios, and managing expenses wisely. This is educational and historical, not financial advice. Another crucial habit is automating your savings. Setting up automatic transfers to a savings or investment account ensures that saving becomes a consistent part of your budget. Even small amounts can grow significantly over time due to the power of compound interest. Additionally, diversifying your income streams can provide financial security and growth opportunities. Whether it's through side hustles, rental properties, or investments like dividend-paying stocks, having multiple sources of income can help protect you against economic downturns and potentially increase your overall wealth. Avoiding lifestyle inflation is crucial. As your income increases, resist upgrading everything from cars to homes. Instead, use the extra money to pay down debt more quickly or fund additional investments, ensuring your net worth grows rather than merely sustaining a higher standard of living. Lastly, regularly reviewing and adjusting your financial plan is essential. Life changes such as marriage, the arrival of children, or a shift in careers require corresponding adjustments to your financial strategy. Keeping your plan flexible and responsive ensures that it continues to align with your evolving needs and goals. This is educational and historical, not financial advice. Building an emergency fund is another critical habit that quietly builds wealth over time. Aim to save 3 to 6 months' worth of living expenses in a separate account. This buffer protects you from unexpected costs like medical bills or car repairs without needing to dip into your investments or incur debt. Automating savings simplifies the process of building wealth. Set up automatic transfers to your retirement accounts, investment funds, and emergency fund each month. By making saving effortless, you can ensure consistent contributions to your financial goals with minimal effort. Paying off high-interest debts should be a priority because these debts can consume a significant portion of your financial resources, leaving less money available for investing or saving. Focus on reducing credit card debt and other loans with very high interest rates to free up more capital for wealth-building activities. Subject the everyday habits that quietly build wealth over time passage corrected. Finally, education about personal finance is an investment in itself. Continuously learning about financial strategies, market trends, and economic principles can significantly enhance your decision-making skills. Consider taking courses, reading books, or following trusted financial blogs and podcasts to stay informed and make better choices with your money. This is educational and historical, not financial advice.